Price to book is the most studied value metric in finance, but it has a flaw most investors ignore. Book value includes goodwill from acquisitions, and goodwill is just an accounting entry. You can't sell it, you can't liquidate it, and when the deals that created it go wrong, it disappears overnight. Tangible book value strips it out. Price to tangible book compares the stock price to hard assets only. The stocks that look cheap on price to book don't always look cheap on price to tangible book, and that gap tells you something real about acquisition risk. Book value per share equals total shareholders' equity divided by shares outstanding. It's everything the company owns minus everything it owes. Tangible book value per share is stricter. It subtracts goodwill and intangible assets from equity before dividing by shares. What's left is hard assets only: property, equipment, inventory, cash, and receivables. Goodwill lands on the balance sheet when a company acquires another for more than its net assets are worth. If Company A buys Company B for $10 billion, but B's net assets are only $4 billion, $6 billion of goodwill lands on the balance sheet. None of it is physical. It represents the premium paid for expected synergies, brand value, and customer relationships. If those expectations prove wrong, goodwill gets written down and equity drops. Comparing the two ratios reveals more than either alone. Two companies at a price to book of 1.5 look identical. The first has a tangible book ratio of 1.8, minimal goodwill, hard assets dominate. The second has a tangible book ratio of 6.0. Most of its book value is acquisition premium. If those deals disappoint, a single write-down slashes equity overnight. The gap between the two ratios measures how much trust the market places in past deals holding their value. Kraft Heinz wrote down $15.4 billion of goodwill and brand intangibles in 2019. The stock dropped 27% on the announcement. Their price to book had looked reasonable beforehand. The price to tangible book ratio had been flagging the risk for years because tangible book was a fraction of total book. General Electric wrote down $22 billion from its power division in 2018 after decades of acquisition-driven accumulation. Price to tangible book had been warning about that concentration all along. The metric works best where assets are primarily physical. Banks and financial institutions are the textbook case. Their assets are loans, securities, and deposits, all tangible, so goodwill stays small and price to tangible book is the industry standard for valuation. Manufacturers, mining companies, and industrial conglomerates also fit. For asset-light technology companies whose value comes from software and network effects, neither price to book nor price to tangible book means much. Both metrics are irrelevant for Alphabet, Meta Platforms, and Salesforce. The academic foundation is Fama and French, 1992, who showed book-to-market predicts cross-sectional returns. Price to tangible book is a more conservative version of that signal. It removes the acquisition premium that may or may not hold its value and focuses on what the hard assets are actually worth. Strip the goodwill out and see which stocks look different. One query against every U.S. listed stock, ranked by price to tangible book, reveals a universe most price to book screens miss entirely. One query against every U.S. listed stock, ranked by price to tangible book, reveals a universe most price to book screens miss entirely. We compute tangible equity directly from the balance sheet. Total stockholders' equity minus goodwill minus intangible assets. Price to tangible book is market cap divided by that tangible equity. And we show standard price to book next to it so you can see the gap directly. The coalesce treats missing goodwill or intangibles as zero, which is correct because some companies simply don't carry any. The null if prevents division by zero. The filter requiring positive tangible equity is essential. Companies where goodwill exceeds total equity produce negative values that are meaningless, and this filter removes roughly 20 to 30% of the S&P 500, mostly in pharma, consumer goods, and media. The remaining guards keep live data clean. The currency check removes foreign filers whose balance sheets aren't in US dollars. The fund and ETF flags remove products that aren't operating companies. And the final row number clause keeps one row per company so preferred share classes don't appear next to the common stock. The results are dominated by financial firms and asset-heavy operators, business development companies, mortgage lenders, insurers, shipping lines, and capital-intensive manufacturers. Their assets are primarily financial or physical, and goodwill is typically a small fraction of their balance sheet. Names trading at a price to tangible book below 1.0 are essentially priced below their hard asset value. What is almost entirely missing is pharma, consumer goods, and tech. Pharma and consumer goods companies have been built through acquisitions, stacking so much goodwill that tangible book goes negative. Technology companies don't need physical assets at all. The interesting columns are price to book and price to tangible book, shown side by side. A company with a price to book of 1.5 and a price to tangible book of 7.5 holds most of its book value as goodwill and intangibles. It looks cheap on standard price to book and expensive on hard assets. That gap analysis identifies where the market is implicitly trusting that past acquisitions will deliver. The simple screen returns companies near tangible book value, but cheap on tangible book has the same trap as cheap on total book. Some stocks are cheap because they should be. A bank at 0.7 times tangible book might have a loan portfolio full of non-performing assets. The 2008 financial crisis proved exactly this. Bank tangible book values were overstated because mortgage-backed securities were marked at par, not market value. An industrial at 0.9 times tangible book might own factories producing products nobody wants. The first filter is a price to tangible book ceiling of 2.0, keeping the screen focused on stocks that are genuinely cheap rather than just sorted from a wide list. The second is return on equity, above 8%, confirming the company earns a reasonable return and isn't simply in decline. Third is operating profit margin above 10%, which verifies the core business generates real profits from operations. Fourth is return on assets, above 3%, checking that asset utilization is adequate. Together, these separate undervalued companies with solid fundamentals from cheap and deteriorating situations the market has priced correctly. Tangible assets can also be impaired. A factory built for $500 million might be worth $200 million at liquidation. Price to tangible book assumes tangible assets are worth their book value. And that assumption doesn't always hold. Depreciation policies vary across companies, so two identical factories might carry different book values depending on the accounting method used. That makes cross-company comparisons noisier than they appear. Companies with massive goodwill, common in pharma, consumer goods, and media, have negative tangible book, making price to tangible book meaningless and excluding roughly a quarter of the S&P 500 from the screen entirely. And like all book value metrics, price to tangible book is backward-looking. It tells you about past asset accumulation, not future value creation. A company might have low price to tangible book because its tangible assets are about to become obsolete. The screen also carries an implicit sector bet toward financials. No quality filter can fully remove that concentration. If the banking sector underperforms, the portfolio underperforms with it. The price to tangible book screen is live on CetaResearch.com. You can swap exchanges, adjust the quality filters, and run your own version of the tangible book screen against any market. Link in the description. We backtested price to tangible book across 15 global exchanges for 25 years, and 14 of 15 beat their local benchmark. Subscribe so you don't miss the results.